The investing adage, "Don't fight the Fed," which was coined in the 1970s, remains highly relevant today. It reflects a core principle. The Federal Reserve's monetary policy decisions can significantly influence markets and the economy, and investors should pay attention. However, it's just as important to maintain perspective. What matters most is the broader trajectory of interest rates, not any one policy meeting. That's especially true now as the Fed continues its rate-cutting cycle in a complex economic environment. As expected, the Fed cut its benchmark rate by 0.25%, extending the easing cycle that began in 2024. Unlike emergency cuts during the 2008 financial crisis or early 2020 pandemic response, this move is about fine-tuning policy to sustain growth, not addressing a breakdown in the system. This cut comes at a time when markets are hovering near all-time highs, economic indicators are mixed, and inflation remains elevated. Understanding how this environment differs from past cycles can help long-term investors make more informed portfolio decisions. The Fed's view is data-driven but divided, which means they evaluate growth, employment, and inflation to guide its decisions. But when the outlook is murky, disagreement naturally follows. Right now, Fed officials hold a wide range of views on how much further rates should fall. This isn't just about political tensions, it reflects genuine uncertainty in the data. Despite this divergence, the Fed has been signaling cuts for some time. Its summary of economic projections throughout the year showed an expectation for rate reductions, though the pace and size have shifted based on inflation data and global developments. The latest projections suggest 2 more cuts are possible in 2025, alongside a slightly stronger growth forecast. This rate-cutting cycle stands apart from previous ones. Rather than reacting to a recession or market panic, the Fed is dialing back the aggressive hikes it implemented in response to 2022's inflation spike. Today's cuts are happening amid a softening, but still expanding economy. Labor market data is showing early signs of cooling, and inflation has proven more persistent than hoped. This approach reflects the Fed's attempt to guide the economy towards a soft landing. Slower growth, lower inflation, and a stable job market without triggering a downturn. Let's look at the data that's guiding them. A key reason for the Fed's rate cut is the apparent weakening in job growth. In August, only 22,000 jobs were added, well below expectations, and prior month's figures were revised down. The unemployment rate rose modestly to 4.3%, but that increase was largely due to a decline in labor force participation. Adding to the concern, the Bureau of Labor Statistics preliminary revisions showed 911,000 fewer jobs created between March of 2024 and March of 25 than originally reported. These revisions suggest that labor market conditions were softening more quickly than policymakers realized at the time. It's important to recognize this is still very different from past crises. In 2008, unemployment spiked from 5% to 10%, and in 2020, it jumped from 3.5% to nearly 15%. Today's data points to a gradual cooling, not a collapse. At the same time, inflation remains above the Fed's 2% target. The PCE price index stands at 2.6%, while core PCE is at 2.9. Headline and core CPI are also running high at 2.9 and 3.1%. Earlier progress on inflation has slowed and in some areas reversed. This makes the Fed's job harder. Weaker jobs data supports cuts, but sticky inflation argues for holding or even raising rates. Balancing these two goals of maximum employment and price stability is the essence of the Fed's dual mandate. For investors, the key question is whether these rate cuts are happening alongside a recession or helping to prevent one. So far, there are signs of economic slowdown, but not a contraction. In this kind of environment, rate cuts typically support markets. Lower rates reduce borrowing costs for businesses, improve corporate profitability, and can increase consumer spending by easing mortgage and credit burdens. Historically, stocks and bonds both tend to benefit under these conditions, especially if growth continues. One challenge today is that the markets are already near record highs. But this isn't unprecedented. In 1995-1996, the Fed under Alan Greenspan cut rate multiple times as insurance against slowing growth, even as markets rose. In 2019, the Fed did the same to hedge against global uncertainty. Fed Chair Jerome Powell recently described the latest cut as a risk management move, citing the rising risk to employment. Historically, lower rates have been positive for stocks, especially growth-oriented sectors, which benefit from lower discount rates and cheaper financing. Bonds may also rise in value as yields fall, though performance will vary by maturity and credit quality. On the flip side, cash and money market yields will likely fall, making them less attractive relative to other risk assets. While no two cycles are the same, history suggests that moderate rate cuts, absent a recession, tend to support asset prices. The bottom line is the Fed's latest rate cut reflects an ongoing effort to support the economy, not a shift towards crisis response. As labor market data weakens and inflation remains elevated, the Fed is trying to strike a balance. For investors, it's important not to get caught up in short-term policy shifts. What matters most is the overall direction of policy and how it aligns with long-term financial goals.